Range breakout strategy. So guys, this strategy is that gem. I've been personally executing this strategy, back tested this strategy, using it live, making big time gains using this strategy. So what are the components? So the first thing we have to do is identify there's a range, then we have to validate a range, and we have to see if the range is becoming non-validated, and then we see have to see the candlestick pattern. Then there's at the end is trade management. So the first thing comes is range identification. That's the very first thing. Okay, what's range criteria? When a candle close is within the high and the low of prior candle, we have a range. Okay, then just mark the high and the low. Look at the picture. In this, I have marked a box, red color box. In that, you notice that the close of this green candle is within the high and the low of this prior big green candle. Then what we did, we marked the a red line on the top, and we marked the red line on the bottom. And the top is the high, on the bottom is the low of the range. So whichever point is higher of those two candles, that would be the high, and whichever point is lower of those two candles would be the low. Range validation. So once we have a range, once a candle, like look at the figure in this, a red candle closes within the high and the low of this prior green candle. So once this happens and the market goes to, it doesn't matter where it goes first, it should made a touch either at the low or either at the high. Let's say for let's just talk about the picture here. In this case, the market went to the low, made a first low touch, then after touching the low, it bounces off and went to make a first high touch. Once we have at least one touch on both sides, one touch and at the bottom or at the top, then the range is valid. Any touch that comes after that, any second touch, we will look for a candlestick pattern. Okay. Okay, we'll talk about range non-validation. Range is non-validated if more than one bar closes outside the range. If two bars have closed outside the range, then the range is no longer valid. Look at this picture. We have a range. The red candle closes within the high and the low of the prior green candle. Notice these two candles, they close outside the range, hence making it invalidated. Okay, look at the figure, guys. In this red candle closed within the high and the low of prior green candle, and hence forming a range. This range is clearly marked using a black box, right? Once that range was formed, the market went up to make a first high touch, okay, and then went down to make a first low touch, and then went up to make a second high touch. And what happened on the second touch, and I had told you guys a few moments ago that we look for a candlestick pattern on the second touch. In this case, it gave us a nice bearish engulfing pattern, and it's marked using a circle. Once we see that bearish engulfing pattern, we would sell it right there, putting a stop loss 2 point above, right? And going for risk or take profit would be twice the distance between the high and the low of the range. Let's say the distance between the high and the low of the range is 10 points, then we will go for 20 points of target starting from the low of the range. Because we are selling, we'll calculate 20 points from the low of the range to the bottom. Okay, So trade management steps. Okay, once we have a range, once we have a range, we have a first high touch, we have a second low touch, then market came up on for a second high touch, we saw a pin bar. Okay, we short at the pin bar, putting a stop loss 2 points above it. The market went down, gave us two candle closes outside the range. Okay, it's marked down with a circle. Once it gives two bars outside the close, two bar close outside range, it gives us a signal that we can add on the pullback. We have already shorted at the top at the second high touch. When we saw that pin bar, we went short. Then market came down, broken the range. It means the range is broken and it's gonna go down. Okay, then we added on the pullback. We added on the pullback and went for 1 to 2 risk reward. Okay, welcome back, traders. In this video, I will be explaining you guys about trade management, how we enter into the trade, what we see, formation of a range, then sub first, second, third touch, then selling on a Japanese candlestick pattern, and then take profit and stop losses and adding on the pullback. Okay, we'll wait for the range to form. If this candle closes within the prior candle, then we'll consider this as a range. See, the close of this candle is within the high and the low of the prior candle. So we'll mark down the high and the low of this range. We'll mark the low in red just to make it more visible. So okay, so this is our first higher touch, first high touch, right? The market touched the high of the range. After the range was found, market has already went to the high of the range and made a first high touch. Then it's coming down to make a first low touch. See, the market has made a second low touch. Oh, sorry, first low touch. Now we are waiting for the market to go up and make a second high touch, which it already did over here. We'll wait for a candlestick pattern, because as you guys know that we sell on a Japanese candlestick pattern on the first second touch, wherever it goes, higher or lower. See, it's forming a pin bar. Will sell once the pin bar closes. Okay, we went short. We'll put the stop loss 2 points above the pattern. Now we are waiting for the market to make a second low touch. From here, two things can happen. Either it can continue going down by giving us two candle closes below the low of the range, or it could bounce off of it and just keeps going higher. If it bounces from the low of the range, if it bounces off from this area, what we will do is we'll buy 2 points above the high of the range. The high of the range is 160.11.75. 2 points above is 160.13.75. We'll mark it down in green color. So this is where we will go long after it bounces off from the low of the range. But for now, let's see. Let's wait for the market to go to the low of the range. So the patience is the key, guys. You guys have to wait a long time for your trades to work out. See, now it has made a second low touch. We are not waiting for any candlestick pattern on the second low touch because it has already went to the high of the range on the second touch. Yeah, we'll buy only if it goes to the this green line which you have drawn. So okay, the market has given us two candle closes, which means it can keep going lower. In this case, what we do is we usually sell on the pullback, sell more on the pullback. So we will put a sell limit order around 997.25. I should have already gone short as market did pulled back to the low of the range after giving two candle closes outside the range. But I just wanted to show you guys how it's done. Okay, so now we'll adjust the stop losses. Our stop losses will be 2 points above the high of the range, which is 13.75. We'll put a stop losses but delete the earlier one. So our take profit, let's just make everything clear, is okay. So our take profit is twice the distance between the high and the low of the range. So this is the midpoint, and then this green line which I have already drawn below is our take profit level. We'll put buy limit, that's our take profit, and this is it, guys. This is it. That's it. Once you guys get to this point, you just have to let the market do its thing, because we cannot do anything else at this point. We cannot push the market down. We we cannot do nothing. We are just small fishes. The big institutions move the market. We don't do anything. we, all we can do is just wait for the market to either go up or down. Patience is the key. You guys have to wait patiently for your trades, for a range to form, or a first, second, or third higher touch, and then make a pullback, and then wait for it to either go up, to your stop loss, or go down to your take profit. And you guys have to be okay with taking losses, because this strategy is not foolproof. It will give you guys some losses sometime, but the thing is, we make more when we win and we lose less when we're wrong.
Okay, because our risk reward is 1 to 2, and when the market pulls back, our risk reward becomes, yeah, I think it's still 1 to 2, but it becomes more than that. See, we are double the position now, and I think more, our risk reward becomes 1 ratio 3. Yes, 1 ratio 3. We win 3 times, then we lose. As you guys can see, it looks like the market is gonna go and hit our stop loss, but you guys cannot trust the market. It will show you something else and it will do something else. All we can do is have a strategy, fixed set of rules, and follow them diligently, because that's the only thing we can do to make profits. Anything other than that is pure guesswork, and we are more likely to lose in the long run. Very nice. So market's heading down. All right. So it did give us a winner. So that's an example of a professional trading strategy, a professional management of a trade, how professional traders manage trades and manage risk effectively, right? All right. So I'll see you guys in the next video.
Position size. So guys, this is the most important topic, okay? Because we have to manage our risk. We don't have to just, put one contract or two contract on every range every trade we see. We have to maintain a proper risk. Let's say you're comfortable losing $100 on every single trade. You should be only losing $100 and making $200. Okay, just for example. So your risk has to be a constant value. Okay, sometimes the distant range would be 20 points, sometimes range would be 40 points. Okay, so you have to adjust your position size based on the volatility of the market. I have shown you a chart. Okay, see, I this is this I use this chart for myself. So I like to lose. So I like to have a risk around, you know, 200, 250. So let's say if the range is 15 points, the high and the distance between the high and the low is 15, I would trade 8 E-mini contract. Let's say the distance is 20 or less, I would for trade with 6 contracts. Let's say the distance is 25 and less, I would go in with 5 contracts. Let's say the distance between the high and the low is 30, I would go for 4 contracts, so that my risk doesn't go up, it stays the same. Okay, work out a position size for yourself. Okay, just use this chart as a reference and you'll be fine, because risk management is the key, guys. This is a very important topic. Okay, range adjustment. Okay, so this, guys, after a range is formed, right? Once a range is formed, look at in this image, this is a range 1, right? But what happened is that one green candle closes above the high of that range 1, but it was within prior candle high and low, hence forming range 2. These both of these ranges can be traded separately at the same time until two bars have closed outside range 1. Okay, this is a very important concept, a range adjustment. Okay,
Welcome, traders, into our video of range adjustment. So, range adjustment, the word itself gives us a signal that how we can adjust new forming ranges with respect to the old ones. So, as you guys can see here on the screen, this is a range, right? This green candle closes within the red candle, right? This is the high and this is the low. But what happened is this candle, I'll mark it down in some bright color, red. This candle, oh my god, the candle right here is closing within the range of this prior candle, but not within this candle, right? So now we have a new range, which is the high is this and the low is this. See? But we still have that old range whose high is this one and the low is this, right? So as we go down, let's just delete all of that. Okay, let's look this for example. So this red candle closes within the range of the prior green candle. So this is a range, right? This is a range, okay? The low is this and the high is this, okay? And this red candle went below the range and two bars has closed outside the range, right? So now this range becomes invalid because two bars has closed outside the range we have, and this green bar is closing within the range of this red bar. So we have a new range whose low is this and the high is this, right? And look at that. So this red candle is closing between the high and the low of the prior green candle. So we have a range whose high is this and the low is, okay? But this candle is closing outside the range, and like two candles has closed outside the range, so the range is broken, and the new range is this. Okay, so that's how you guys will adjust to new forming ranges. The old ones become invalid, or they would still be valid if two bars has not closed outside of those ranges. Let's look at this range. For example, this green bar is closing in between the range of the prior red bar. So this is the high and this is the low. Okay, this green bar closes above the high of this range, but the second bar comes back inside the range. So the range is still valid, and this again, this red bar closes outside the range, but again a green bar comes back in. Okay, so this is a very good example of, okay, this was the range, this was the, I'll use eclipses. This is the first touch, this is the second touch, and this is the third touch. And one more thing I want to explain, this is no touch, this is wrong. This is not a touch. Why? Because market has to, after making a touch, it has to go to the other side first. Okay, so this is not a touch before, because it's not coming back after a touch on the low of the range. So this is second touch. We sell from here, the market went down. Okay, we would have already took our profits. They were, and this, let's look at this example. This red bar closes within the range of this green bar, and this bar is closing outside the range of the outside the prior range. But it's, what happened is after that, this is a new range because it's within the range of prior candle but outside the range. So we have two ranges at the same time, and this, and two bars close outside the first range, so the first range becomes invalid. Now we only have this, right? And let's look at this. This green bar closes inside the range of this red bar. It went up, the mark turns back in the range. First touch, first first touch, second touch, oh sorry, first touch, and this is second touch, and this is also a second low touch. After hitting the second low touch, I went up. Let's see what happens. Market pulled back in the range, or consolidated for a bit, then There you go. My God, massive move. Massive, massive move. See, there's a lots of power in trading ranges. You trade what normally other people don't even see. No one trades these ranges. Why? Because these are my own personal findings. You cannot find this strategy in any book, any article, not even any other person. No one is using these strategies because if because we all see something different in the markets and we all have a unique way of trading, and this is my unique way. And I hope once I set you guys up, give you guys some information, and in the future you guys will be able to create your own personal strategy based on your market knowledge. So let's come back. Okay, let's look at this. This green candle closes inside the range of a prior candle, and this
Trade adjustment. So guys, this is I have laid out this foolproof trade plan for you guys to navigate in times of stress, in times of uncertainty. Okay, when you don't know what's going on, like because people make mistakes following a strategy. Why they make mistakes? Because markets doesn't do what is written in books or text or what somebody has told them. So I have laid out this foundation, this trade adjustment, how you can adjust your trades based on the market conditions. So okay, in this figure, market went to make a first low touch, market made a first high touch. Market range is validated. Now, once it came down to make a second low touch, we will buy on a candlestick pattern. Is that clear? Once we buy on this candlestick pattern, why on imagine there's a candlestick pattern, okay, marked in that red circle. We buy on the candlestick pattern. Market bounces off. Market made a second high touch. Once it go make a second high touch, usually what it does is just keeps going higher. But in some cases, it's gonna touch the high second time and pulls back. Once it pulls back to make a third low touch, it can do two things. Either it can bounce off, either it can continue going straight. If it continue going straight, we would sell 2 points below the low of the range. Is marked with this blue arrow, selling 2 points below the low of the range. Okay, if it comes back after bounces, reverses after making a second high touch, and if the market keeps going down, we would put a sell stop order 2 points below the low of the range. But if it didn't fill our order, or if it did fill our order, but instead of going straight down, it reverses after making a third low touch, we would have a buy stop order 2 points above the high of the range. Okay, and our stop loss 2 points below the low of the range, and that's it. This would be the end of the race. Okay, this we after that's what we gonna do. This is the steps. If it doesn't go straight after the second low touch, we gonna sell on its way down after the second high touch. If it doesn't go straight down on the second high touch, we will buy it back 2 points above the range after the third low touch, and that's it. Okay, so guys, I have given you guys a very good example, right? Okay, in this figure, you guys see there's a range. Okay, there's a range marked with the black box. Market made a first low touch, then the market made a first high touch. Market came back down, gave a nice pin bar at the second low touch. We would have bought there, put our stop losses 2 point below the pin bar. Market reverses after making a second high touch. We would sell 2 points below the range. Our order would have got filled, but the market reverses after making a third low touch. We would buy it again 2 points above the range and put the stop loss 2 points below the low of the range. The market gave two closes outside the range after the third low touch. We would have added on the pullback, and there you go, profits. Okay,
Welcome traders, welcome to our video of trade adjustment. Here in this video, I will be teaching you guys how to adjust the trade once you are already in the market. Okay, so far you guys know the first thing you have to do is identify a range. And then once you identify a range, you have to wait for it to be validated, which means you have to wait for one touch on the top and one touch at the bottom, and then wait for a candlestick pattern on the second touch, either at the high or the low of the range. So once we are in the trade and then it bounces off, what do we just stay still or we do something? That's what I'm gonna answer in this video. So as you guys can see, this is a range. This candle closes within the range of prior candle, right? Or maybe this is also a range. Okay, horizontal line. There are like two ranges at the same time. That's a very good example. Okay, two ranges at the same time. This is one range and this is one range. Okay, okay. What happened here? Market made another range. So we have three ranges right now. So see, this candle closes within the high and the low of the prior candle. So this is a different range. So I know there's a clutter. It's very difficult. We'll just take off the this range. Okay. So the low, this is the low of this range, and this is the high of the same. And this is the low and this is the high. Okay. And the market has made one touch. Okay. Market has made the second touch. Okay. We are waiting for the next touch, which would be our second touch, and we are waiting for a candlestick pattern here. If we do get a candlestick pattern, we are going to go short. See, this is a second high touch. We will go short if we see a candlestick pattern. Okay, this does look like a candlestick pattern. Engulfing. Okay, sell. We'll put a stop loss 2 points above the pattern. Okay, and now it can do two things. Either it can stop us out or can continue going lower. Okay, we'll take off the previous low as well because that has become invalid because two candle has closed outside that range. So we only have this range for now. Okay, and I'll tell you guys about the target too. Target is twice the size of this range. Okay, twice the size of this range, which is this. Understood? So the high is 99. Okay, so we got 2 points above. Let's see what happens. Market is gonna go lower or it's gonna break up above and start going higher. Market stopped us out, and it's giving another engulfing candle. Look at clearly, guys. The range is not broken yet. There was just one candle which closed above it. The second candle is coming back into the range, forming an engulfing candle. Okay, we'll go short as soon as this candle closes, which is closing in about 10 seconds. And we'll put the stop loss above this pattern. We're gonna go short. Sell. Put the stop loss above it. 4 point. You know, twice the size of the range. So we already have our take profit. So now we'll wait for this to hit the low of the range and bounce back. Okay, bounce back. Now we're gonna buy 2 points above it. We'll buy at 299. If it bounces, if it breaks and continue going lower, we're not gonna do anything. Okay, if it bounces up, we'll buy 2 points above the range. Okay, this is our second low touch. We'll delete the previous ones just to avoid any confusion. So this is the, we're waiting for it to go up 2 points above this line. Okay, if it goes 2 point above the high of the range, we will buy. Okay, and then if it fills our order and starts coming down, then we'll sell 2 points below this range and put the stop loss 2 point above it. So that's how it's gonna work. Okay, So we'll put the stop loss 2 point below. We'll cancel that one. Okay. And if it starts coming back down into the range, if it start coming back down, we will sell 2 points below the range, which is 86.75, 84.75, and put the stop loss where our initial entry was. Okay, so this is a reverse trade. This was a third higher touch. Okay, third higher touch. This is a perfect example of what you guys will do if you guys find yourself in a situation like this. Market didn't went straight down after the second touch. It bounces back from the other side, and then it bounces back after hitting that high again. Okay, this is what you guys will do. Do you guys will sell 2 points below and buy 2 points above the high and the low of the range. So see, I bought one contract, and my sell stop is of two because I want to reverse my trade. I want to close my trade at 984.75, and I want to go short one more contract. Okay, that's why I have two of them. This is my stop loss. The target for above will be like this. Okay, this would be the target if the market starts going up, and the target for below is this market. Okay, so we'll put the stop loss at 99 because the market went ahead and filled our, okay, market approaching our buy limit. So if it pulls back, we'll sell more if it pulls back. Okay, but if it just fills our order, we're not gonna do anything. We we would want to sell one more contract here. Okay, put a sell limit here. But if it fills our order, we're not gonna do anything. We're just gonna end the race here. Okay, so that was a clear example of how we will adjust once we are in the market. Okay, we'll do a recap. Market gave us a pattern here. It stops us out, and then gave us another pattern. We sold, then it bounces off. We bought here, then start bounces off from the high. Oh, reverses from the high and filled our order and filled a take profit. Okay, that's what happened, guys. Okay, most of the time what will happen is market will not stop after the second touch, but in some rare cases it will make a third touch. Okay, will make a third touch, and then you guys have to adjust your trades accordingly, according to what I have described in the video, in this video and the prior videos. Okay, so this should be a fixed rules for you guys. Okay, you guys have to just follow it. Don't, do and in the moment what you feel or what you think. You guys have to follow the rules because rules will make you money. Okay, Guesswork will not. These are the rules I'm laying for you. You just have to follow those footsteps. The strategy, I've been using it myself for many, many months. I have back tested many, many years. The strategy has a probable outcome, but what it's gonna do on a single trade, nobody knows. There's uncertainty on a single trade, but a certainty on a series of trade. On a larger sample, you'll have certainty. But what will happen on a single trade? Nobody knows. It could be a loser, it could be a winner. Your job is to keep following those rules. Whenever that range comes up, whenever this range like this comes up, no, and market and that range is validated, it goes to the it made a first low touch at the bottom and first high touch at the top, then it's coming to make a second high touch or a low touch. You see a Japanese candlestick pattern, you either sell it or you buy it depending on the range. Whether if you're buying, you should be buying at the low of the range, or if you're selling, you should be selling at the high of the range. And then if it bounces up from the opposite side, you just follow what I have just described you just few minutes ago. Just follow this again and again and again, and you will start seeing money flowing in your trading account. Do not get discouraged by losses. Losses are part of this game. You cannot eliminate those losses. If you are scared of losing, I'm sorry, trading is not for you. You have to become a best loser in order to win in this game, because these win loss distribution is in cycles, and there are big market cycles. When market condition changes, right, these are big cycles, because I have been in the market for a very long time, and I know those cycles when works nothing works. What No matter what type of strategy I'm using, nothing is gonna work. And the key is to manage yourself in those moments, not showing any irrational behavior, and you know not managing risk properly. You're thinking, I have many losses, now this trade is gonna be a should have to be a winner. No, it doesn't. Market doesn't know who you are, doesn't even know whether you have put the trader on. Market does not know you, does not know that you are following some kind of a strategy, and that this I have given losses to this guy, or I should give some winners now. No, we are just a very small fish in the vast ocean. Does the ocean is going to get affected whether that fish dies or lives? No, it will have no effect. So your job is to follow the rules, become a machine. Follow the rules that I have given laid out for you. Backtest it. Backtesting is the best way of learning. I'll tell you guys how I became good at following rules and good at executing my strategy. I started getting up early morning, 4 o'clock, for 3 months straight. The very first thing I did, every time I woke up early in the morning, I would sit in front of my computer and I would start backtesting. Backtesting is a way of seeing past price behavior. L- So, in your cases, the backtesting would be like, getting in front of your computer, open up a 2 year old chart of NASDAQ or whatever, go to 9:30 time frame when the market opens and start watching what happened in those that time. If I would have followed my strategy, how many points would I have made, how the market reacted, how many losses it would have given me. Get a record, see yourself, watch how the strategy has performed in the past, so that it gives you confidence to stay on your rules, to stick to your strategy when you're losing hope. Okay? All right, guys, that'll be all for this video. I'll see you guys in the next video. Okay? Happy trading.
Video. In this, we will be talking about some examples of range trading strategy, or how you want to call it. So, in this strategy, as you guys know, we are waiting for a range. The first step is to wait for a range. Okay, range. One second. So this is a range. The market opened at 931. Green candle closes within the high and the low of this red bar. Mark mark the top and the bottom. Okay, this was the first touch. This was the first touch, and this was the second touch. We would have sold here. The market went up, end up being a loser. Okay, so then come back over here. This is a range. This red candle closes within the range of this green candle. Okay, so I'll put a high and a low. Okay, and then first touch, first touch, I'll make it smaller. Second touch. Okay, market formed a range, came back to make a first low touch, went up to make a first high touch, came back down to make a second low touch. We would have bought here on the spin bar, and the stop loss would be below it. Okay, but the market bounces off after the second high touch. Okay, market went down, giving us two red candle close outside the range. We would have gone short 2 point below. We would have gone short at 54. I'll mark it down in a red color. Would have gone short. Our stop loss would be over here somewhere, 2 points above the pattern, 470.75. The stop loss would be at 472.75. Okay, so we gone long first, but then the market stopped us out. We reversed the trade because it was coming after the second high touch, as explained in the previous videos. Okay, the market gave us two candle closes, one this and one this candle. Two candle close outside. Market pulled back. We would have added on the pullback. We would have sold one more contract on the pullback, and there you go. Market went down big time. Okay, I'll be talking about take profits as well later in this video. I just want to show you some examples of how this thing work, because take profits is just an art, because there is not one size fits all. It's just different. Okay, come back here. So I don't think this is a range. So this one, once I formed a range. Actually, those were ranges, but those were not validated. Okay, those were not validated. What do I mean by that? Let's say this this green candle closes within this red candle, right? You mark the high and the low. Okay, the only thing was the first touch. This was the first touch. Okay, but then what happened is market on the second touch, market gave two closes outside the range, so that becomes invalid. Okay, so this red candle closes within this green candle, so market made a first touch, first high touch, second low touch. On the second low touch, it gave us a nice pin bar, or we can call it a other bullish harami pattern. So we would have bought here, and there you go. There you go. There's no stopping to it. Nobody can stop this movement. See, it's a massive move. Okay, okay, another one, I guess, but no, that's not a trade. Okay, let's move on to another day. This okay, this is a smaller range. Okay, so this red candle closes within the this green candle. Mark the high and the low. Okay, this was the first touch. This was the first low touch. Second high touch. We would have gone short here, but the market reverses after making a second low touch. Market went up. It went up a little bit, but it came back down. We would have got a loser there. Market tried to go up, but it didn't go so far. It didn't go so far. Sellers pushed it. We're gonna have some losers. Even doesn't matter what strategy we follow. Okay, so that's why I'm showing you guys the both sides of the coin. It's not some secret formula that I'm giving you that's gonna give you winners all the time. No, you have to face the harsh reality of day trading. Okay, let's find some other example you couldn't find here. So the pattern, this pattern, range trading pattern, right? The pattern we are looking for, it happens very rare. It doesn't happen all the time. So it helps us to not to overtrade. Look at this. This is a nice one. Okay, this red candle closed within this red candle. Okay, Let's mark down the high and the low. Was first low touch, first high touch, second low touch. Market went up, gave us a nice bullish engulfing pattern, and there you go. It went up, up, up like crazy. Good, right? That's a very neat and clean example. Wow, didn't even came back whole day. It closed right at the top that day. Okay, let's find some other examples. You guys have to train your eyes to find this pattern. The only way to do it is backtest as much as you guys can, so that you can become familiar with the pattern formation and the results, so that you don't you know stop using it once you get some losers using this strategy. Because in my early career, I would follow a strategy, and once it starts giving me losers, I would just abandon it sl- and start looking for some holy grail. There is no holy grail. You cannot eliminate losing in trading. Losing is a part. Losing, you have to be a good loser. Okay. Okay, let's come back. Okay, this is a good example. Okay. Oh my god, where did it go? This red candle closes within this red candle. Mark the high and the low. First low touch, first high touch. This is the second low touch. So, did you guys see the market gave this nice pin bar? We would have bought it at the pin bar. Our stop loss would be 2 points below this pin bar. Our stop loss would be at 2602. Okay, market, we would have bought here, stop loss here. Market went up, gave two closes outside the range on the other side of the range. We would have added on the pullback. Once we would have added right here. Okay, there you go. Boom. How can you tell me this does not work? See, so many big moves from the breakout of the range. All you have to do, you have to be able to capitalize these moves, right? Because many times I have seen people using a strategy, like once they hit a losing cycle of that particular strategy, they would stop using it, and once they stop using it, the market start the strategy would start giving them start strategy would start producing good results, but they won't be there to capitalize on it, because they would have already get discouraged from losing. it's it's 6:30 in the morning, and I'm recording it. Tea tastes so good. Okay, let's move on to You guys have to spend a lot of time with this strategy in order to master it. I would say I would say you have to spend 1 month backtesting it. Backtest at least 1 to 2 year of data. Record that data and live test means trading real time for at least 3 months. Yes, then so you will be able to backtest 1 to 2 years in about a month, and then 2 to 3 months live testing. It means 4 months. It would take 4 months for you to become really good at executing one strategy. Okay, and at the end of this video, I'm gonna give you a tip, a really nice tip that took me years to understand, and which was the key to consistent profits. Let me show you guys some more examples and then we will wrap up. Okay, look at that. Even though this was also one. Okay, but anyways, yeah, the closes were outside. Okay, I'll just show you guys a loser. A loser, okay? Alright, the market made the first touch, market made a second, oh, first low touch, second high touch, and second low touch. Market went up. We would have gone short here, right? Market stopped us out. We would have bought here, and then it gave us two closes outside. We would have bought it on the pullback. We would have bought. We would have bought here on the pullback. Okay, then boom, the market reverses big time. Okay, that's an example of a loser. We will also get loser from this strategy. Okay, right. And this looks like a good example. So see, this green candle closes within this red candle. Actually, all of these candle closes within this green bar, right? But this green candle is higher than this. See, this close is higher. So we will go with the recent range. The close is within the prior candle, but not within that this candle, right? So this we're gonna trade this range. And market, because market gave two closes outside this range, so we'll just make that range an invalid range and then start trading this. But even what happened here with these two give market give two closes outside. Okay, then adjust it, because these two candle closes are within the range of these two candles, so we'll adjust to these. Okay, I have explained you guys these concepts in our range adjustment videos. If if the recent candle is within the range of a prior candle but not within the high and the low the of the candle before, of the third last candle, I'm sorry, third last candle. Okay, in this case, this green candle was within the range of this red candle but not within the range of this candle. Oh, sorry, the high and the low. Okay, let's just come on to this example, and then we'll wrap up. Okay, first high touch, first low touch, second high touch. Nice engulfing pattern on the second low touch. Market went down. Mm, okay, market went straight back down. We would have shot, pulled back. We would have added on the pullback. We would have added over here. The market went straight down. Okay, that's a perfect example. Perfect example. So this is like finding order in chaos. Like, how would you have known that the market is gonna go down? There is no way you could know in advance. The only thing in trading is we can play the probabilities. Probabilities is the holy grail, and the key to profitability is changing the way we think. We like to think in certainty. We have to start thinking in terms of uncertainty, in terms of probability. And the only way to achieve that kind of mindset is to go through a very hard period of executing a single strategy. Doesn't matter what type of strategy it is, execute that strategy. Stay with one strategy for a long, long, long period. Never give up on that strategy. If you think something's wrong, it's not producing results, find what you can do to make it better. Find what adjustment you can do to make the strategy work for you so that it brings you profits. Or you can always reach out to me because I have designed a lot of strategies which were not profitable before, and I know the right steps to take in order to make a strategy profitable. And there are a lot of pitfalls. Our mind is the biggest enemy. It is not going to let us stick to one strategy. Once the strategy start bringing losers, it wants us to move on, jump to another strategy. You have to understand, cause it will try to convince you so that you don't use that strategy. And any change you want to bring to your strategy should not change the whole strategy. The baseline should remain the same. The adjustment should only be small. Okay, making a big adjustment is just like changing your strategy. The only adjustments you're allowed to make is take profits. Take profits. Yes, you cannot change the entry and the exit criteria. Entry and exit criteria should remain the same. F- Okay, I said in the middle of the video that I'm gonna give you a tip on how to achieve consistent profits. So here you go. First of all, you guys will start off with 1 to 2 risk reward. Okay, the strategy, use the strategy, backtest the strategy. Okay, use 1 to risk reward as the the profits will be twice twice your range. Okay, once you guys get comfortable with executing that strategy, you guys started trusting that strategy, and you have built a probabilistic mindset executing that strategy for 3 4 months. I'm talking about 3 4 months, not a week or 2 or 3 weeks. Okay, after that you will start going for 3 times the size of the range. You will stay there for 3 weeks, 3 to 4 weeks, I would say a month. And after that, start going for 4 times the size of the range. Your take profit would be 4 times. And then after that, 5 times. Okay, this would be the key. Taking big profits is the key to achieving consistent profits in the market. Because what happens is whenever we are in a trade, we market give us profits, our minds wants to just materialize it, just take it, because it wants to feel that it was right and made profit. I knew a guy that he was trading stocks on Well Simple. He said whatever I see, I just take it. Even if I see a $15 winner, I just take it. Even if I see a $20, $50 winner, I take it. As soon as the market goes in my favor, I take the profit. In my mind, I was like, this guy has some serious wrong information. And he showed me his portfolio. He said he bought crypto, and but crypto went down. He is in major loss. I think he's losing about $5,000, right? But he didn't close that trade. His trades are still running. You guys see the pitfall? He don't want to materialize the loss. He don't want to be a loser. He wants to win all the time. The only reason he didn't close those crypto trades, even though they're in big losses, because closing them would be a proof that he lost on that trade and he's a loser. He don't want to do that. And he's still waiting for the markets to come back up. And I'm pretty sure as soon as the crypto market would come up, he would just get out in a small profit. See, he was had a big loser. He's having a big loser right now, but he's okay with small wins because he wants to feel good, feel right. If you want to feel right, I'm sorry, this place is not for you, because markets are going to prove you wrong time after time. Time and again, you'll be proven wrong. Me, I go for big, really, really big wins. I let my trades run from 9:30. If let's say I got in around 9:30, 10 o'clock, I stay in the market until the closing bell. If the market is it's going in my favor, and I keep on adding more size to it so that my winners are monster winners. When I lose only $200 right now with the risk. My risk appetite is just $200. Like, okay, I risk $200 on every trade. I have a 75% losing rate and 25% win rate. You know, when I win $1,500, $2,000. When I lose $200. See, that's how you will achieve consistent profits, going for the big wins. And you cannot just get up early in the morning, you know, and just start going for big wins. Your mind is not gonna let you. It will give you huge resistance, big time. So you have to get up there slowly. The take profits. A level I gave you is twice the size of the range. You guys go for that first, and you guys add on the pullback. Keep doing that. Go for twice the range, and month after month, start stretching your profits. Start going for three times the risk, then four times the risk, then five times. Stop at the five times. Just keep doing, and you'll see the results.